everybody. Thanks a lot for joining me in this weekend market update. What I wanted to do was just speak about our little strategy that we sort of applied to the market over the past 5 trading sessions and a longer term strategy that we have been employing since early June 2017, since the majority of these markets have continued to see the bullish runaway and breakout above the recent macro resistance areas. It's very important that you get an understanding of what we're doing on different time frames and have a strategy, have a game plan, so to speak, of how you're going to approach the market forward looking, and what you can make sense of what is occurring in the current marketplace. So the Dow Jones Industrial Average over the past really 5 trading sessions, it has popped to the upside. Let me just bring this into perspective for you. You can see we closed up on the weekly chart 223 points. What is impressive about this is that we have now definitively broken above the previous 3 weeks worth of upper wicks. This is a very bullish signal for the market. We have closed at new historical all-time highs, and it took until Friday for the market to achieve this. So what we were looking at going into the market or moving into the week that has just been was that we weren't really going to act until we saw either the market break out above resistance, which is what inevitably happened on Friday, or if the market pulled back down to lower areas to look to be getting involved if we saw candlestick construction around 21,100. So we were triggered into a bunch of bullish trades, or at least market exposure on Friday. And if we just recap what has been going on, we've been sort of jumping into, or at least slowly accumulating longer term positions at certain pivot points, trigger points on the chart itself. When I say longer term positions, we're talking about contract expiration, knowing that if the market does break above certain key areas, then it should continue to trend indefinitely until we get major reversal signals, or at least chart patterns, or even candlestick individual sort of daily candlesticks that suggest a pullback or a correction in the marketplace. So since June alone, we've been bullish at 21,243. We've added at 21,353. We've added again. I mean, some of these triggers I need to move because they're sort of blocked by some of these past candlesticks. The third entry was 21,435, and now the fourth entry in the past 1 month is now at 21,566. All are profitable. For a short time, the third trigger here at 21,435 was slightly underwater. However, we understood that the market itself needed time to adjust, or at least digest, these new all-time highs. And as such, when these oscillating indicators flick into a correctional type of cross, it doesn't mean that you move bearish on the market itself. It just means that, again, the market needs time to rest. So this was only a temporary sort of underwater position, or at least one of the previous 3 entries. But obviously, as the market has continued to advance itself to the upside, we're now sitting very, very profitably in a lot of these longer term positions, which is fantastic. Now, the reason for this, and again, just to bring the different levels, or at least the different fractals of breaking down markets, is that, look, we can have these long-term positions, we can have long-term market exposure on the markets themselves, okay? Whether or not, I'll just write them on the chart, whether or not you want to trade the diamonds, the DIAs, or whether or not you want to trade the SPYs, that's all okay as well, or even the Qs. Okay, they're the widely sort of traded, at least indice ETFs that, you know, are obviously optionable too. When we move into a season like we are the week upcoming, or even where we find ourselves now, we're in the midst of earnings. Okay, we are a little bit hindered in terms of really good trade setups. The reason for that is because we don't really want to hold these option positions or any sort of short-term trading positions over earnings. The reason for that is because it's largely unpredictable which direction those individual trades are going to move. So the good news for a lot of people in that pro class is that, look, they've got open capital exposure to the markets, which we assume is going to sort of continue indefinitely over X duration, over any given duration, which is going to offset potentially a little bit of slowdown in the way of individual trades, which are going to be hindered essentially by earnings and their respective earnings calls. The week upcoming, we have a lot of stocks reporting, and what I will be doing is in the private area, I will be reporting on those gaps and the good news and the benefit of gaps and gap analysis, and obviously the direction in which the stock gaps and breaking down a few other components once that gap has established itself, is that it brings with it tremendous trading opportunities. So even as at this weekend, I've just recorded that class, it is up online, we do have a lot of trades which are ready we also have a lot of trades which unfortunately have earnings. Now, the majority of the list are done. I mean, essentially done by next week. So in 2 weeks' time, we have more or less rotated through, I think, 11 of our top 12 trades. I think the only other stock outside of that list will be Tesla. Maybe no, actually not Baidu. So it's an interesting sort of time for markets. Essentially, we're at these new all-time highs. And I mean, if you look at different sort of valuation metrics, there is a little bit of pressure as to what this earnings season is going to bring, given, of course, some of these standard deviations outside of these long-term historical sort of means that we have in the world of financial analysis, or at least trying to break down markets from a valuation standpoint, let alone the technical blueprint of what is going on as well. So it's very important that you get your head around how the market is moving, I guess the sentiment of the market, and I guess try to move in synchronicity and the expectations of what the market is set to bring you. At the moment, it is all very favorable. These markets are continuing to break out. Also, if we bring up the transportational average as well, you can see this just continuing to the upside. We've broken out of a range which we've been sort of stagnant in since late 2016, which is very exciting. You can see the CCI holding above or just below 200, which is very, very powerful. And even when we look at market breadth as well with the Russell 2000, I mean, this is one of the final markets outside of the NASDAQ to truly confirm this breakout, even though the NASDAQ has been leading, of course, the industrial average in the S&P 500. But again, we're essentially here on the precipice. The ADX is reset. The CCI is it's already turned up. It's already above 100, which is fantastic. And we're just holding above some of these very important ranges, which is what we would expect to happen before a market continues its upside advance. So everything is looking good. Very excited over the next couple of months worth of trading. But if there are any material advancements or breakdowns or sort of structural sort of implications of what price action is doing, I will also bring this to your attention as well. But until then, I just wanted to speak about obviously what I have just referenced. I want to wish you all a very nice weekend as well, no matter where you are located around the world. It's a pleasure bringing you this analysis. I'll be back with you during the week for some more market updates, but again, very exciting given some of these gap movements that we're going to see throughout the week upcoming worth of trading. So on that note, everybody, I will say goodbye to you. It is James signing off on behalf of Pivot Point Trading. Enjoy your weekend, and I will see you next week. All the best. Goodbye.